back here when this first starts. No, we won't, because we already muted that speaker, so there we go. So we're good to go, Mr. Chair,
Okay,
and it is 5 o'clock.
okay, we'll call the meeting to order. I have someone move that we approve the agenda.
I'll move.
And I guess we need a seconder on that. Yeah, that Mike seconded it.
Yeah.
All in favor, signify by saying aye.
Aye.
Does anyone have a conflict of interest to declare for this evening with regards to the agenda? Have you heard none? We'll move on to staff report, post-closure review. Don, I guess you're doing that tonight.
I am,
Okay,
and Tony is supposed to be joining us. There we go. And I'm just sending him a reminder that there he is. Good. So, Mr. Chair, as we've done in the past, I'm going to review last quarter's performance of the post-closure fund. And after that, Tony will brief us on what the outlook for the future appears to be at this time. Our report for the last quarter is generally a good one. The fund is within its asset allocations for cash, fixed income, and equities. And for the quarter, we earned a return of 3.88%. So, on an annual basis, if we did that every quarter, we would have a return for the year of about 15.5%, which is well above the 4.84 that's necessary. And you should be aware that that 3.88% is a little lower than it might otherwise be, because there's a portion of our investment that is in American dollars, invested in other currencies in other countries. And the Canadian dollar has been somewhat strengthening. So when we figure out what's our return, we calculate, well, what would that be in Canadian dollars? So in essence, we buy fewer Canadian dollars when the dollar is strong. And but it gives us diversification of our risk from just straight Canadian dollars. Going forward, there's kind of a consensus that we should see a softening of the value of the Canadian dollar, and that will have a beneficial effect or impact on our portfolio. The biggest uncertainty that we dealt with in the last quarter, and I'm sure that Tony will talk about going forward, is COVID. And just this week, I think it was Tuesday, that the markets got very nervous because of what the infection rates were in the United States. There was a big drop, and then it bounced back the next day. The market always seems to, in the short term, overdo things, and then it looks for, then it normalizes over time. Here's one difference in the report that you received this quarter than from the past. You'll recall that we tried to look how are our investments doing relative to the markets. What we used to do is we used to compare them to market benchmarks, which weren't exactly our asset allocation. And so we had, to some extent, we had apples to oranges. This quarter, in the report, we produced a table that showed our investments and which quartile they fit in. Now, quartile is, for financial performance, a well-known concept. It takes all the performances in a certain fund category and basically divides them into 4 groups. And if your fund is in the first quartile, it's outperformed 75% of the other funds. It's in the second, it's outperformed 50. And so 1 is good, 4 is bad. And there's a little more math involved in that, but you know, that's a pretty good summary. And we've produced all the funds that we own in this table and how much of our investments the particular fund makes up. For example, Fidelity's conservative income pool is almost 17.5% of our total investment portfolio. And in 2020, the last year for which there's data, it was in the second quartile. So it was above average performer. But compared itself just to conservative income pools and not to, say, high tech or manufacturing. If we look at all of our funds for 2020, you know, rather than have you kind of see into it, I highlighted 4 of them. And they're all Russell's funds. And they all have not so good numbers. They're either in the 4th quartile or the 3rd quartile. And the reason for that is that Russell has a reputation of being very conservative and structuring funds that will protect you in down markets. And if you look at how those same funds did in 2018, when the markets were not performing well, Russell was in the 1st quartile in 3 of them, and in the second on the first one. So there, you can think about them as, you know, we're on the high wire and they're our safety net down below that. So, so we should expect them to continue to kind of lag the market. And it's not because they're not good, it's because tactically we've chosen that degree of safety. So, you know, on balance, our funds are outperforming their comparators. Our return is in excess of what we need. And we don't see any reason at this time to change the asset allocation or our investment strategy. So maybe before I open it for questions, I'll ask Tony sort of give us a view of what we think might be coming in the future. And because that'll be related to what has happened in the past. And if it's okay with you, Mr. Chair, we'll do all the questions after that.
That's fine.
Go ahead, Tony.
That's great. Sorry for kind of signing in late. I'm on vacation and Wi-Fi is not quite as good as it should be. I panicked there right at the tail end. I didn't think I was going to make it at all. But anyway, as Don indicated, you know, IPS is in line. Actually, for the year, we're at 6.31%. He had just given you kind of the quarter update. And again, he highlighted and kind of indicated that, you know, a rising Canadian dollar against the US, you know, has really a negative impact on the total valuation, because our valuations, you know, on the US stock coming back into Canada, he is 100% correct. If nothing else happened to the markets over the last year, our dollar appreciated, you know, about 10%, which is a negative 10% on the funds themselves. So we do expect and anticipate that to kind of bring itself back down and going forward. And, you know, so we will kind of recoup that and feel good about it. You know, the world and of course the markets now are seeing the lingering of COVID, which Sean indicated. It's now been 16 months. It's still in the news and it's not positive, although it's a little more sporadic. Recently, it has been a little bit more information relevant to the variant. But, you know, we are starting to, I think, at least wish for the end of this. And so the market itself has been holding its own, although, like Don indicated recently, we've seen, you know, a little bit more volatility. And again, that's why we do hold funds like Russell. They're pension style management. They protect to the downside. And when we have markets running very hot or very high, it's nice to have that in your portfolio. And if you look at kind of the numbers, 2 or 3, or actually in 2018, they were running first quartile, which was the last time we did have a kind of a market crisis. So we do like where we're at. That being said, there's still negative news, you know, that is out there, although we are starting to see some positive news, you know, a quick and strong kind of economic recovery is what people are anticipating and seeing. We're also, still concerned about over the next, say, 3 to 6 months, possible new tax initiatives that are going to be out by both the US and Canada to pay for COVID. We do see inflation, although the US are saying not as rampant as maybe we're seeing in Canada, which is not positive for the markets, actually negative. But we do expect to see some more stimulus spending at the same time because the governments are very aware that they don't want things to spiral downward and head into a depression. So we will see the markets kind of react both up and down to this. There's also what's going on out there now as things start to ramp up. There's a shortage of workers for sure, but also a shortage of some of the key parts or key things that are needed for an economy to move forward. And I'm not sure how close people watch things, but if you're looking at the car dealerships, even in Fredericton, you see there's not a lot of cars sitting in the dealers. And that's part and parcel because they couldn't get a bunch of these computer chips to continue to build them. And that was part and parcel again because of COVID. When it was shutting down the factories or the workers weren't even working. So it has had a negative effect on kind of the economy from that point of view. And as we work our way through that, we do expect that it's going to, again, buoyant or give some buoyancy to the markets. So while there's a lot of negatives out there, everybody is really wanting positive. And, we do see that as happening, although it's probably going to be 3 to 6 months out. Summer is habitually soft. People are on vacation, myself included. But, it's not kind of like, let's get at things. And we usually see that start to happen September, October. That coupled with people returning to work, kind of get your sleeves rolled up. And when I say returning to work, it's not going to be like before. Everybody's in 5 days a week, but it's almost like the end of the summer that you do sit down and you say, okay, let's roll our sleeves up and let's get back to work. And that's positive for the markets. The other thing is the U.S. US/Canada border. Canada is opening up earlier in the U.S., but that's also a positive thing. Companies out there have got good profits. The recent kind of earning releases that have been out have been very positive on a lot of the companies, the banks, especially, and we see that as continuing on out. That coupled again with, a stronger US dollar or a weaker Canadian one tells us that, our portfolio is positioned correctly, or we feel it's positioned correctly to kind of reap, the rewards that are out there. And, so while we are definitely going to see volatility, that is kind of the norm now. And I know we've been talking and preaching that for the last couple of years. It's not going to stop. It's going to happen. And, on a short-term basis, it's no fun when we're seeing, a 6 or 7 or 800 point drop in the Dow. But this portfolio is actually, very long-term. And so that kind of daily gyration, while we don't like to see it and hear it, over the long term, the portfolio itself is still on its way up and as Don indicated, well exceeding the required return that's necessary. So, we're not looking to change things. We're very kind of content with what's going on in this kind of a market. And, as we move forward, we probably will at some point reevaluate a little bit stronger, where we're at and maybe the need for exposure or asset allocation similar to what we have there now. But for the time being, we're happy and content. So, my suggestion, kind of like everybody else, enjoy the summer. Come fall, I think it's going to be much tighter, much tougher, and hopefully much stronger, from an economic point of view, but also much stronger from everybody's point of view. We've been sitting out there kind of buckled down, and maybe we can kind of get out in the open a little bit more. So that being said, kind of content. Like the numbers year to date, especially with, if we actually added on kind of the decrease caused by the stronger stronger Canadian dollar, we'd be up a little over 10% year to date. But that's not the number. The actual number, 6.31, I think is the number. So I think that kind of, in a nutshell, wraps it up from my angle. Definitely open for any questions or any comments, anything that you people are seeing out there.
Okay, thank you, Tony. Does anyone have any questions or any comments?
I don't know.
Mike Chamberlain.
Yeah, Mike, go ahead, Mike.
I just wondered, bringing up the climate change and diversification, which seems to be a buzzword nowadays. Just wondering how much of our investments are invested in the fossil fuel industry, and our funders. What is their opinion on this? Who are we investing in?
I don't have specifics. I definitely, can kind of dig into it, although you are correct. It is a buzzword, or it's kind of, the word that's on the tip of everybody's kind of thought process. If you don't COVID, then it is, clean energy, what's going on. And a lot of the fund managers are taking that into account. As far as zeroing in and knowing exactly, kind of what percentages we are, I wouldn't even want to guess at that. I'm even uncertain how clearly I can kind of give you an answer to that, other than that is not a bad idea that maybe Don and I can discuss as far as making sure that we are allocated to it. Again, the managers themselves, when they're investing, they're looking at this for sure. But I don't think I can really give you, kind of like a target shot of what percentage is in there. I'll dig into it a little bit, but I really, even in trying to come up with an answer, I don't think I can give you a number. Other than I can kind of guarantee you every fund manager that is out there that's working on our behalf has that, on the front burner. And it's not good black and white, gray. Good question. Not such a good answer, but I don't know. Is there somebody out there that's listening or in on this that might have a better vibe on it? It's not that we don't pay attention to it, but unless somebody actually comes in and says, okay, I want 10% of my money allocated only to clean energy, or, something away from, the norm, then, it's not something that we actually allocate and do on a regular basis.
I can
So,
understand that, and I would appreciate maybe in our next meeting, you could ask some questions and.
Yeah. I'll do a 5 minute, or 3 to 5 minute kind of zero in on that for sure, and that's appropriate. And again, it might not be any more than what I'm telling you now, but at least we'll get kind of a much better educated kind of zeroed in answer on it for you.
Thank you,
So-
Tony.
Mr. Chair, if I might, I think that we can, at the next quarterly report, give a bit of a range of what we might have in the fossil fuel industry. I have to remember that while all of these funds publish their main holdings at a certain point in time, we can look at that and we can come up with some information. But many of them are conglomerates that are only partially exposed to the fossil fuel business. So Tony's quite correct in that it's difficult to get to it. The other half of Mike Chamberlain's question is about green energy and what exposure do we have in green energy. And there are green energy funds that are available for investment. And I think if we just look at what we have in fossil fuels, we're looking at half the equation. So I'd like to come back in the next quarter and with a staff report about green energy funds, green energy investing, and so it's appropriate for us regularly to kind of look at what our asset allocation is. It's not appropriate for us to change it sort of on a whim because you pick it for a long term, but it's an area worth exploring and seeing whether or not we have an interest in dedicating a certain portion of our fund to either clean energy or ethical investing, or there's a fund for everything.
That's correct. That's correct. And again, I'm very comfortable telling you that, there is a very solid thought process by the fund managers, and we would definitely have exposure to that. But until, you know, like Don indicated, if we actually said, okay, we want, you know, a specific allocation to a specific fund, it's a tougher thing to go at. So anyway, I have it marked down here, and Don and I'll probably discuss this a couple of times before the next meeting. So we'll definitely be back to you on it.
Okay.
Thank you.
Thanks very much, Tony. Listening here, I agree with what you and Don will do for the next meeting. I think we need to be a little bit careful with the way we've divested our funds, not to dig too deeply into every one of them, because that's not our job. You know, because you can't extend green and fossil to ethical, and it goes on and on and on. So, but thank you, and we look forward to your comments at the next quarterly meeting.
Yeah.
Okay.
Perfect. That's actually a solid point also.
Okay. Any other questions or comments for Tony before he gets back to his vacation? Tony?
Okay. Listen, enjoy the rest of the meeting. Have a good evening, guys.
Thank you.
Okay. Comments. I think Mary Kay, you would share the second quarter results with us and discuss them.
Certainly. Thank you, Mr. Chair. I'm just going to take a moment and share my screen with everyone. All right. Everybody see that okay? So this is the balance sheet as of June 30th, which would mark the second quarter of 2021. As always, I'll go through the changes that occurred from the previous month and just kind of tell you the story of what's going on. So cash has decreased $323,000 from May. And if I scroll down a little bit further, you'll see the reason why. We actually had 2 debenture payments that were made in the month of June, totaling $431,000. So you see a corresponding decrease in this municipal bonds payable number, as well as a decrease in the accrued debt servicing. So all those relate to our debt payments that happened in the month of June. The other change that I want to highlight is our capital assets increased $140,000. So typically what we do is we record our capital assets twice a year. So at the 6-month mark and then at the end of the year. Many different organizations do it differently. You have the option to do it monthly. You could do it annually. You could wait for your auditors to do it. We've just chosen to do it semi-annually, which seems to work well for us. So those increased $140,000 for the first 6 months of the year. The major capital asset purchase was $60,000, and that was for the power generation engine overhaul. So that's included in there. And then there were a number of relatively small ones. We do have some capital purchases that are coming up in the next few months. So that will change again in December as well. And so when you add to your capital assets and when you pay off debt, that means there is a corresponding increase to your investment in capital assets. So that went up about $570,000 the same time period. So we finished the month of June with assets and liabilities and equity totaling $22,714,000. Any questions on the balance sheet? All right, that will bring us to the income statement. And as always, I'm going to focus on the actual year-to-date column as well as the variances. So starting with the regional planning division, for the first 6 months of the year, regional planning had a surplus of $32,429, which was about $15,000 higher than what we had expected for the same time period. And if you look above, you'll see what generated that favorable variance. It was expenses being less than what was budgeted. So we had spent nothing for administration expenses in the first 6 months, and our corporate service expense allocation is running under what we had budgeted by about $5,200. For the Planning and Development Division, to the end of June, we had a surplus of $634, which was about $4,700 less than what we had budgeted for the same time period. Jumping up to revenues, you can see revenues were slightly over budget, and that relates to our Blue Plate revenue sales. And then expenses are trending over budget. And there's a couple of reasons for that. We did have one additional employee hired in planning and development, and that was necessary just with all the various inspections that are going on to maintain our level of service to the various communities. An additional employee was required. So we are expecting to have an overage with regard to salaries and benefits. And then the other area was corporate service expense allocation. So we changed, when we do the budget for 2022, you're going to see this a little bit more. So I want to take a moment to just explain. Previous to us going to the cloud, all our IT expenses were charged out to the various divisions that use them. When we went to the cloud, we actually started charging everything to corporate services and then allocating them out that way. So the reason you see an overage in corporate services expense allocation here is because they're paying for their share of the IT expenses. So it's just a different way of recording them. At the end of the day, you get to relatively the same place, but just something to be aware of. So with all of that said, I do expect over the next couple of months that we're probably going to see planning and development slip into a deficit. July and August are busy months. So it is going to be a challenge for this division with the additional employee in there. And I fully expect that it will probably be a deficit, which we're going to have to manage over the next few months. Any questions on that page?
Mary Kay, if I might, just clarity, under planning advisory services?
Mm-hmm. Yeah, so
is that the individual you were talking about?
No, that's actually in operating expenses. You can't see that because it's masked by the IT a little bit. But when you look at the specific line, the salaries and benefits, it's in operating expenses. Planning advisory services, there's a couple things that are going on there. I believe we have 2 additional members on PRAC, and when the budget was done, it was done with 10 members. So that's contributing there, as well as there was a meeting in December that was not expensed last year. So it's included in your 2021 actuals as well. So that's contributing to the overage there.
Okay, thank you.
Mary Kay,
Yes.
you say we have one more employee, but we also have one less employee, do we not? And Stephen?
So I can respond to that, Mr. Chair. That's true. And but we won't see the impact of that in our salary expense until 2022.
Thank you.
So next comes the solid waste division. And for the first 6 months, the solid waste division, the landfill specifically, had a surplus of $787,556, which is approximately $44,000 over the budget for the first 6 months. Revenues are trending slightly over budget. So both our garbage and our C&D add up to about $31,000 that's over budget, which is good, means our tonnage is higher than what we budgeted for the first 6 months. And then we are seeing a decline in our asbestos and ash, about the same. So it's pretty much a wash in the end. And then there's some small sources of revenue that are contributing to the 6,000 favorable variance. On the expense side, for the most part, we are trending under. Anything that is trending over, with the exception of this corporate services, is a timing issue. Post-closing is a little bit over just because our tonnage is a little bit higher than what we had budgeted, but very small. And then the only expense that I will bring to your attention that is running over would be our professional fees. And those are related to our engineering fees with regard to our EIA. So the longer that goes on, the more expenses that are incurred with regard to that. For the recycling, we are at a deficit as of the end of June of $351,240. Which is actually $89,000 less than what we had budgeted, so that's favorable. And we're seeing that our revenues are higher than what we had budgeted, specifically with regard to cardboard and our metals. Are we getting higher prices than we have in the past? And a lot of people are doing shredding, so that's running high as well. So it's kind of interesting there. People are purging, I think. And then on the expense side, there's no specific expense that's running under budget. Pretty much all of them are not very much under budget. So it's all kind of contributing to a small favorable variance with regard to expenses. So adding those two up, we see the 89,000. And then when you add your landfill surplus, your recycling deficit, for solid waste, you come up with a surplus of 436,316, which is almost 134,000 favorable variance. Any questions on that one?
Yes, Mary Kay,
Certainly.
what's the status of our EIA? It seems to be taking a long time.
I'm gonna let Brett answer that one.
Can you hear me okay, Mike?
Sure.
Yeah, good. Sorry, I'm in Tweed side and my cell phone signal isn't great. I agree with you. It does seem to be taking a long time. We've prepared our final response for the third round. There's typically 3 rounds from the technical review committee, and we're hoping with this response it'll bring it to a head. But there's no guarantee. In an ideal world, we could expect to hear back from them in September. But just because they typically do 3 rounds doesn't mean they couldn't do 4 or 5 or 6. So there is some uncertainty there with when dealing with the province on these things. But again, in an ideal world, we'll be done by mid-September.
Thank you, Brett.
You're welcome.
All right, so moving along to the last page, we have power generation. So for the first 6 months, power generation had a deficit of 153,113, which is 119,000 higher than what we had budgeted for the same time period. Looking above, you can see that our revenue is higher than what we had budgeted, which is good. We have had more engine uptime, which bodes well for us. But the area that is unfavorable relates to our engine maintenance. But I guess I have a little bit of a story with regard to this. So our planned maintenance, which would be I believe the 40,000 hourly maintenance interval, that was done earlier in the year, whereas our budget has been allocated out evenly through the year. So our expenses, while it looks unfavorable, it's just a timing issue. And where most of that planned maintenance has been completed, all that remains is anything that's unplanned. So if there's an outage that a piece of equipment needs to be replaced or a part, something like that, we have about $100,000 left in our budget for the remainder of the year to deal with that. And if we can keep our unplanned maintenance to under 100,000, we should be able to meet budget with regard to power generation for 2021. So adding all of the various divisions up, we have a consolidated surplus as of the end of June of $316,266, which is $25,000 higher than what we had budgeted for the same time period. Any questions on that one?
Mary Kay, if I might, just the consolidated surplus, how does that number compare to where we were a year ago?
I don't have the figure of what it would have been in 2020, Peter, but I can certainly get that for you and send you a message if that would work for you.
Okay, that would be fine. Okay. Thank you, Mary Kay. Are there any further questions on this, on Mary Kay's report? Okay, well, again, thank you. And we can just move on with agenda. Official budget discussions. Donna,
Thank you, Mr. Chair. So we are reasonably well along in our budget construction. There are a number of unknowns at this time that we're working on, but we kind of have a sense of where we might land with our recommendation to you next month. So just to sort of preface what you hear, the first thing that we look at when we start to put together a budget, because it flows across all areas, is we look at economic adjustments for salary ranges and benefit costs. So on the salary range adjustment side of things, we've settled for this draft on a level of 3%. And we picked that because it's the top of the Bank of Canada's target for inflation. Even though inflation right now, the most recent numbers, it's running at 4.3%. So, we're picking a number less than our current experience. There's a bit of optimism in taking that 3% rather than 4.5% where it is now. We're hopeful that I guess we're hopeful is the word as opposed to optimistic, but we're hopeful that going green, more areas going green will see lumber prices start to come down, and we see a little bit of indication of that now. There's a lot of uncertainty, a lot of talk now about fourth wave, so don't really know what's going to happen, but we feel relatively comfortable by the fact that we're not sort of just taking the number that exists right now. We've given some thought to that. So talked about the COVID unknown. On the planning side, we're going through a bit of a restructuring, and Lonnie and I are working on looking at that budget in a little bit of detail. We talked about the additional inspector that we have that was more or less forced on us by the Department of Public Safety's changes in building permit model, where our experience is going to go from like 450 to 1,500 a year. Those are round numbers and almost certainly not correct, but you get the idea. It's significant amount of more work. We're trying to be smart about that. We're looking for operational savings and how we can be faster and smarter. But we do expect the total expenses on the planning side to come in somewhat above the 3% salary range side of things. And PRAC is going to be a big part of that. Our pre-COVID history with PRAC was typically a meeting every other month, unless it got unusually busy. Well, with COVID, we all know what people started to do with their houses, and we're having a meeting every month now to respond to demand, and we're having 12 committee members attend rather than 10. So that budget will, compared to the previous budget, it'll look larger, but it's reflective of what we really are going to expect on that side of things. On the solid waste side, there's a lot of uncertainty as to what we're going. Well, there isn't really a lot of uncertainty. There's a tiny bit of uncertainty. Either we'll get the EIA or we won't. There are dramatically different financial implications of that. So we are working under the assumption that we will get the EIA approval. And we are then saying, okay, what if we don't? What are the differences? And we're trying to quantify that. And so I believe that we will be able to come to you in August and say, we expect to get the EIA approval and this is what will happen. And if it doesn't, this is what will happen, and that's what the magnitude is. And then the committee will have a decision to make whether or not they want to go through to the board with the assumption that we get the EIA, or go to the board with the assumption that we don't. Those models aren't completely fleshed out, but I think you would be that you can anticipate that we're going to recommend get the EIA model. At least that's where our thinking is at this time. So, and the other thing is, we have significant expenses for a major refit on the power generation. And so we're going to be recommending that a significant amount of that be borrowed. And while we haven't got the numbers exactly, our sense is that we will come handy our target of 15% debt service. And we may slightly go over it. If we do, it will only be for 1 year, because then the original debt on the power generation gets paid off. So those are all the moving things that we have. We're meeting regularly about it. And Lonnie and I and Brett and Mary Kay can give you a little more detail if there's a specific area that you're interested in, but that's more or less the Reader's Digest version.
Okay, Don, thank you very much.
You're welcome.
Does anyone have any questions for Don or Mary Kay at this point? Mike, go ahead, Mike.
I would just like to reinforce this comment I made about the EIA, and Don has too. I don't understand what takes so long in the bureaucracy to make these decisions. This has been going on for how long, Don?
Well, close to it. We've been in the planning phases for over a year, and then we had our public, we had our public presentation, Brett, in February or January?
It was January.
January. Yeah. What's going on is that a small number of people, and when I say small, I'm talking, you can count them on one hand, said this will create more odor. Well, here we go. Right? So we got a response back from them that was very much focused on odor, and we had to do some work to demonstrate that, and I say we, I mean Brett and his team, that this would actually reduce odor. And so we acquired, Brett can, I'm going to invite him to explain it in more detail, but computer modeling to identify when we were and weren't buying the odors. But if you think about it, and this is in my original thought, it's Brett's, there's a reason smokestacks are tall, and that's because the odor is up there and it goes over our head. We're doing the exact same thing with the landfill. We're going up higher, and so it should minimize odor. But the people in Lincoln Heights, the 5 of them that are against this, their real objective is nothing to do with this EIA. They're hoping they can close the landfill down and have it relocated. But Brett, maybe you can share with the directors what we've done on the odor monitoring side.
Yeah, sure, Don. Yeah, it was in an effort to be proactive, and so we've entered into a 1-year agreement with a company named EnviroSuite, and they're headquartered in Australia, but they've got quite a presence in North America, Europe as well. The system involves a network of sensors that will, we've done modeling, so what they call windrows modeling, which basically tells you where the predominant winds are coming from at any given time of the year. In our case, it's typically from the southwest. And then you install a weather station on your site, upwind, that's your background information. And then downstream on your site, we're installing a system, I believe, of 5 sensors that are checking for the gases that are typically associated with the odors that people may smell. It's a pretty sophisticated program, and the real benefit, I don't expect that we'll find any odors. Our old-fashioned way of analyzing complaints was simply we process them, we look at historical data, and if the wind's blowing in their direction, well, it could be us. The new system actually takes topography into account. It's much more sophisticated, and it also incorporates other odor sources that are in our neighborhood. So disused sewage lagoons, plant or pet food processors, sewage processors. We have all of those in our neighborhood. And the way it'll work is if a member of the public has a complaint, they'll go onto our website, log the complaint, their address, and the time, automatically generates a work order. It gets crunched by the artificial intelligence, and it'll spit out a response immediately where the smell is coming from. And it'll give us the kind of credibility that you wouldn't have if landfill staff simply dismissed it and said, no, it's got to be somebody else. They think you're just putting them off. But in this case, it'll actually identify the potential source of the odor. And so that was an effort to be proactive. Like Don had mentioned too, we have 2 engineering consulting firms, both well-established and both experts in this field, telling us the same thing, that odors will actually be reduced through a combination of increased gas collection efficiency and what Don referred to in dispersion from a higher altitude. So we're confident that it makes a lot of sense, but you know, the department is being very detailed in the review, and so we've done the best we can to put our argument forward. And I hope that this latest round will be the last one. But again, there's no way to be certain about that.
So inside every cloud, there's a silver lining. And the cloud here is that we've acquired this stuff because we're tired of anecdotal conversations with respect to odor. So because politicians, you know, they react to that because people complain about it, and people complain, you know, they're not concerned about being accurate with their complaint. They're just angry that they smell this. And so it's time for us, I think it's appropriate for us to have science-based responses so that if it is us, that we can take mitigation, you know, we can work to mitigate it. And if it isn't, you know, we can dispel that and free up a lot of PR time that we do trying to manage individual relationships with consistent complainers.
I totally agree with this.
Brett, could I just ask a question? On the monitoring, you're saying that you can determine, the system can determine where the odor is coming from. Are you saying that if it's coming from the pet food plant or the sewage lagoon or whatever, that's what the report will tell you?
Yeah, well, that's correct, Peter. This flowed out of the result of our initial analysis of a lot of these odor complaints, which, and to put it in context, we hadn't received a single odor complaint for, I believe it was, and this is just off the top of my head, but I think it was 2016 was the last one that we'd received prior to our public consultation. The majority of those complaints that we received were at times when it couldn't possibly be us. The wind was blowing in the complete opposite direction. However, all complaints are taken as valid during this review. And so in an effort to scientifically deal with these and really point out the fact that, listen, we're located in an industrial park. There are manufacturing facilities, like I say, abandoned sewage lagoons. There are all kinds of potential sources. We thought it would be a good idea to put this kind of a system in place. To begin with, it's only a 1-year commitment, and then if it's successful, if it works, and as Don mentioned, it's fantastic for public relations. If it's successful, it's something that we can look at continuing long term.
Great, thank you.
You're welcome.
Odors are interesting, coming from factories.
Aren't they?
Company that they roasted and ground and packed coffee in a suburb of Montreal, and they were complaining about that. And I guess if you get too much of a coffee odor, perhaps it is over. Keeps you awake all the time, perhaps, I'm not sure. But you know, we had to go in and put scrubbers and what have you in the system to take care of that. Anyway, thank you.
So that's where we are, Mr. Chair. We're not finished. We have a sense of what the picture is. We believe that the board will favorably see the budget, most particularly on the solid waste side, and we believe that they'll understand the modest what we think will be a modest increase over 3% that planning has, given the circumstances.
Well, I think what we can do with, at this point, from my point of view, is have questions for the next meeting in August, unless somebody has a question they'd like to ask right now. Give you folks a chance to build upon what you have now and come back with what you will be asking us basically to go to the board with. So, I have questions tonight, but I mean, since you haven't brought it into one pack, just questions.
Sure. And Mary Kay, I think our first session is August 10th,
The 12th, I believe.
August 12th, the Thursday.
Yes.
Yeah, so we'll have a fully formed package then, and we'll have it out to you a week before with not just numbers, a bit of a narrative to go with it. So help you form your questions, and we'll do our best job to be prepared to answer them on the 12th.
Okay, sounds good. Thanks everyone for their input on tonight, and certainly on the initial budget discussions. It gives us an idea of where we might be going. Does anyone have anything else they'd like to discuss this evening under item 7? I don't. No. Okay. Then could I have a motion for adjournment? Seconder? David? Okay.
Yes.
Been moved and seconded that we adjourn. So thanks everybody for tuning in. Enjoy your holiday in Tweedside, Brett.
Thanks, Peter. I'm hoping to get out on the boat this evening after this. So we'll see.
Lots of time.